If you have too much business tied up to too few clients, your business is very risky because your clients could go bankrupt, they could choose somebody else, and so forth. You want to have a stable growth, okay? You don't want to
Interesting.
have growth like 50, 60% a year because the question that the buyer is going to say is, okay, that trend really doesn't seem sustainable. Don't take advice from your neighbor. Take all the barbecue and all the drinks that you want, but not advice on how to sell a company.
Welcome back to another episode of Construction Tech Talk, where we blend the traditions of the trades with the innovations of the future. Today, we got a special guest in the house. We got the Roofing Biz Broker, Claudio Vilas. And my man is out here helping buy and sell roofing businesses. He's going to teach you the key to success. It's a hot topic right now. My man, Claudio, what's going on?
How you doing? How you doing? Great. Thank you for having me in your podcast. It's always fun to talk with you, and I love following you in social media and so forth. So it's an honor for me to be here, and I appreciate your inviting me. I'll answer any questions that you might have, but there's a lot of things going on right now in the mergers and acquisition space, and there's some myths out there. There's some truths, and there's some, like they call it, misinformation about it too. So hopefully I'll be able to clarify any questions or any ideas that you might have. Let me know what you got.
My man. Hey, the Mythbuster is here, so we'll definitely break into that. So yeah, stay tuned. We'll be solving those myths for you guys. But I got a question for you. People hire a realtor to sell their house,
Yes.
but for some reason, some people try to sell their business on their own.
Yeah.
Why is that?
Because they have no idea how hard it actually is to sell a business. Every time I get a new listing, for example, I had this listing this week, and on Monday I sent over 500 emails to potential buyers. By the end of this week, I will have reached about 1,000 buyers. Out of those 1,000 buyers, I'm probably going to get 400 or 500 responses. Out of those 400 or 500 responses, we're going to sign NDAs with about 100 and so forth until we get to one. And that's the beginning. That's just the first step in a business sell. Once you do that, then you have to vet the buyers and actually know that the buyers have the money to buy the business. One thing that business owners don't know and is that the market is tremendously full of tire kickers that don't even have the money to buy the business. And they ask questions and they make you waste your time and so forth. If you're actually a serious business looking for a serious buyer, you really can't do it on your own. Anybody that sold his business will tell you that it takes a lot of work. And like I said, that's the first part. When you go into the due diligence, when you go into the quality of earnings, when you go into what you need to ask your buyer, okay, the buyers are going to do due diligence on you, but how are you going to do due diligence on the buyer? Who do you know? How do you know who they are? So people think that it's just putting an ad in I don't know, in Biz by Sell or something, and it's way more than that. When you go into the accounting of the business, 99% of the businesses that I start selling, they are in cash accounting. Buyers are looking for accrual accounting. And to
Mm-hmm.
actually get from cash to accrual accounting is not that flipping a switch in QuickBooks, it's actually doing a different type of accounting. So most people that sell their business on their own, they end up screwing up something and not getting the best deal for them. Now, many people get emails like every day. Oh, I'm interested in your business. I'm interested in buying your business. So the way
Mm-hmm.
I compare that is to the same emails that we used to get in the past. Remember from the prince in Uganda or something that he had $40 million to give away and he couldn't find who to give it to. This is pretty much the same thing, right? There's a lot of people fishing for businesses. The emails that you receive don't necessarily mean that they even know who you are. It's just a foreign email, spam. My job is to actually, and that's a biggest one big part of my job is to know who the buyer is, know if they actually
Yeah.
have money, know if they have a curriculum, they have a history, they know what they're doing. Everybody can call himself a private equity, and anybody can create a website in 2 minutes. You can create a website showing how wonderful you are, but when you start digging under the hood, you realize that's not the case.
100%. I love all that. I got a bunch of questions from that though.
Go
So
ahead.
like the accrual, instead of being on the cash, the cash reports, something like that, is that just basically they want to look at your AR, get an understanding of what that looks like? Can you maybe explain that process of why
Okay,
that's
so
so important?
it's extremely important because the accrual normalizes the earnings of the business or the P&Ls of the business. If you're doing on a cash, let's suppose you are doing cash accounting and you pay all your insurance on January, right? So January, you're going to have a big expense that says insurance X amount of dollars. But that insurance was for the whole year. So in accrual accounting, that's going to be distributed
Mm,
on in all 12 months of the year. If not, it looks like you have a high expense in January. And if somebody comes and looks at your business in January, your business could show that it's losing money, but it's not that it's losing money. You're paying things in advance. But the opposite happens too. When you sell a job, for example, let's suppose you sell a roof and for some reason you're lucky and you get 100% paid upfront. Okay. So if you did get paid upfront and you're using accrual, sorry, if you're using cash accounting, it looks like you sold, I don't know, $20,000 this month. It's not true. You didn't sell it because you only received the money. You will sell it when you finish doing the job. So you have to use work in progress. You have to use, by using an accrual accountant, it tells you how far you are within that sell.
mm,
So accrual is crucial for understanding the business, but not only to sell the business. And this is conversations I have all the time with business owners. Accrual accounting and the right accounting allows you to make right decisions for your business. There's a lot of reports that you can create, a lot of ratios that you can use to analyze your cash position in your business. One quick thing that I can say about that is, for example, working capital. Nobody that I ever talked to understands and knows what the working capital is for their business. They go, oh yeah, we need this much money or whatever. But if you actually do the right analysis, it's going to tell you how much working capital is. And guess what? Most business fail because they run out of capital. Why? Because they don't know how to do this. Accrual accounting, finances, making sure you understand your financial statements, which is basically three. You have the P&L, you have the cash flow, and you have the balance sheets.
balance
Okay.
sheet.
If you know all three of them, and you know how to read them, you're not only going to be in a much better position to sell the business, you're in a much better position to manage your business, which is
So
sometimes
true.
even more important than actually to sell it, right?
Built to sell, right? Go in
Yeah,
with the
build to
mind.
sell. If you build to
Uh,
sell, you start from day one thinking of how your buyer is going to look at the business. And the funny thing is, I talk to so many business owners all the time, and the first thing that they can tell you is how much they sold. How much did you sell this year? Oh, we sold 4,245,000, whatever. And how much money did you make? I don't know. I got to ask my accountant. So when a buyer comes in, he's not asking you how much are you selling, what your revenues are. The first question is how much are you making? For them, it's
mhm.
so much more important how much you're making than what you're selling. It is important, of course, your revenue, how much your revenues are, but the number one question is what is your EBITDA, right? EBITDA means, and many people always say, what is EBITDA? EBITDA is simple. It's all the money that you make before you pay interest, taxes, amortization, and depreciation. It's the number that is used to do a valuation of a business. And actually, it's actually what's called the adjusted EBITDA. So you take that EBITDA, you adjust it for whatever the owner is expensing that shouldn't be expensed in the business. We all know that people put anything in a business expenses. What we do as brokers, the first thing we do is we look at that and we take all that out, which is called recasting, and then how much the business is making. And once you know how much the business is making, then you can value it. But it's interesting for me to see that many people just put so much emphasis in sales, which is not bad, but they forget about the cost part and they forget about the fact that a business needs to make money. And if a business needs to make money, you need to know how to track that money. That's a number one thing that you should be tracking. That's why accrual accounting is so important. That's why
Mhm.
understanding your numbers is so important.
Mhm. So let's say that we have a potential buyer that is doing their analysis. Obviously, you mentioned how much money you actually taking home. So they're looking at profit margin. What else are they looking at where it's like you really need to focus on these metrics? You nail these metrics, you got a valuable viable business.
Great point. Yes. The fact that the business needs to make money and needs to demonstrate how they make money, we just made it very clear. It's the number one issue. Now, that is not enough to actually make a business valuable. The second one, right up there with the profitability of the business, is whether the business owner is or isn't a part of the business. The less involved you are in the business, the higher the valuation of that business. And it makes sense because the buyers are not buying you, they're buying your business. They need an entity that will thrive after you leave. And if you are the do all end all in the business, once you leave the business, there's no business, right? So you're not really
Mm-hmm.
able to transfer that. So I typically advise my clients to make sure that they have a strong management. Strong management is an extremely important part of evaluation of a business. Can your management do and make the decisions without you, or they depend on you every time they want to go to the bathroom? Right. So that's the thing.
Mm-hmm.
What are you selling when you sell a business? Think about this. I mean, the business is air, right? It's got money coming in,
Mm-hmm.
money coming out. There's nothing really tangible in a business, except of course for whatever trucks you have or anything like that. But that doesn't really add much to the value of the business. The business is the people that run the business, how well they run it, and how much money they make. So your best bet if you want to sell a business is to take yourself out of it, delegate as much as you can, and have a strong management. The strong management
Mm-hmm.
will come with strong processes, which is the third point that you need to focus on. Okay, so you're making money, you have strong people. If you have strong people, you're probably going to have strong processes because the processes are what going to make the business continue in the future. Okay, and then, of course, you want to make sure that you have the right culture in the business. And the right culture is going to vary a little bit because it's uh, something that could be the right culture for me might not be exactly the same as for you. So it has to do with the relationship between the buyer and the seller. And that's a key issue as well,
Yeah.
because most people forget about the human factor when you're selling a business. And most sellers, when they sell to private equity and when they sell to investors, you're typically selling a portion of the business today, reinvesting and selling a second portion in the future, what's typically called the second bite at the apple. And if your culture doesn't align with the buyer's culture, that second bite at the apple could be a very rotten apple, right?
Yeah.
Or it could be a great apple if you align well and everything goes well. Those are the key issues that you want to make sure. Now, sorry, I keep ranting.
No, keep
So
going.
stop
I
me
mean,
when you
this is the
want.
knowledge we're looking for, right? At the end of the day, we're looking for a guy. People hear me enough, so it's all good.
Okay, fine. So I'll just keep ranting. So it depends on the type of roofing company that you have. There's a couple of other things that you have to be very careful with. If you have a commercial company, a commercial roofing company, you're typically going to have a lot of customer concentration, which means that only a few customers will make more than 80% of your sales. The 80-20 rule happens all the time, but if you have too much business tied up to too few clients, your business is very risky because your clients could go bankrupt, they could they could choose somebody else and so forth. So every time I
Oh
have a
yeah.
commercial roofing company, the first thing I ask is, okay, send me your last year's sales by client, by customer. And that's the first thing that I ask because I've seen it. 80% of my sales come through from two or three clients. Well,
Yeah.
then you're in trouble. You're in trouble because your business is very risky. The other thing, of course, is what most investors don't like is to have new construction. So they typically ask for very little new construction, maybe 5, 10% new construction, but that's very risky as well. At the end of the day, a business valuation is a balance between two things, the risk and the rewards. Okay. So anything that adds risk lowers your valuation. Anything that adds rewards is going to increase valuation. Okay. If you can make it easy, if you can make it predictable. That's the other thing. How do you predict the sales that you're going to have in the future? And this is very hard for small businesses. They don't have huge budgets for market research or anything like that. But just an idea of, for every rep, I sell X number of roofs. Therefore, if I add 5 reps, I'm going to add five, whatever number of roofs. That's the kind of thing that buyers are looking for.
And then how do they come out with a valuation? Are they looking at the trends? Let's say I was doing 1 million, 5 million, 10 million, 15 million over the last X amount of years.
Mhm.
How they can come out with a valuation for that?
Okay, I can give you the academic and the book answer, or I can give you the real answer. Okay,
Give me the real answer, hey?
that's better. I like
Yeah.
real. The books will tell you one thing, but at the end of the day, what happens is there's anything else. There's supply and demand. That's books as well. There's supply and
Yeah.
demand, and the bigger the demand, the higher the price. In today's situation with roofing, there's a lot of demand. There's a lot of people looking for roofers, so that's increasing the valuation. Exactly, that's increasing the value. It's not going to go forever, but it's not going to end next year. By the way, it's going to go for a few more years. So the determination of the price is you take a EBITDA, an adjusted EBITDA better, and then you multiply it by a factor, and you are going to get the valuation of your business. That factor varies depending on everything that I just told you, plus the needs for somebody to buy you. So there's one thing called the most probable selling price. Okay, most probable selling price. That's the number that we give the seller. Okay, I tell him you're according to where you are today in the market, the most probable selling price is going to be $5 million. Now that's just an estimate that is going to bump up against the actual market. And in the market, you're having different buyers. You have financial buyers and you have strategic buyers. Okay, the most probable selling price will give you an average of that. Now, if you can find a strategic buyer, you're probably going to sell at a higher price to that strategic buyer. Why? Because that strategic buyer is buying you for more than just the EBITDA. Let's suppose you have, I don't know, you're here in South Florida and you have a roofing company in Broward and you want to expand to the north. You want to go, I don't know, to Palm Beach or whatever. So you find another company that's compatible to yours and that you could buy it. And rather than actually going and trying to gain that market share and putting an effort and everything, you just buy the company and you already have the market share. So you're being a strategic buyer, right? You're buying that company and immediately you're going to take, I don't know, their marketing, you're going to take their accounting, you're going to take their production, and you're going to lower your costs because you're going to have those synergies. A strategic buyer can get a company that makes $1 million in EBITDA and make it make 1.5 immediately just by the fact that they're buying them and that they're doing synergies with it. That's completely different than somebody that is going to buy it, but really doesn't have a synergy or any strategic reason to buy. That's why private equity typically is thought of as a financial buyer. And another company, a competitor, or maybe another company from another trade that wants to increase their footprint in the same area could pay more. So price, like I said, it's very variable depending on too many situations. Okay. There's not one size fits all.
Roofers, stop wasting time and money. Our free guide, 10 must-have roofing tools for 2025, will save you 52 days a year, boost your close rates by 23%, and supercharge your profits. These tools are transforming the industry. Don't get left behind. Click the link in the show notes to download it now and dominate 2025.
What about if I was buying a business? Recurring revenue is enticing me. Obviously, in roofing, there's not a lot of recurring revenue. Is
No.
there anything like commercial service work or anything that's kind of like people are chopping on the bit? They like to see that type of stuff. Anything like that, or not really in roofing?
Well, any buyer, and including in this industry, is looking for ways to make recurring revenues. You want to do recurring revenues. That's why when you have maintenance programs or any kind of program that can actually bring revenues all the time. Or maybe happens in the north, for example, when the winter comes and you really can't be on top of a roof, you want to have something else in the company, maybe interior design, or maybe, I don't know, other
Ice
things that
dams.
will allow you to stay. But recurring revenue from the same client in residential roofing is very difficult to get. But that's
Uh-huh.
part of the business. That's part. Like people who look for a lot of recurring revenue, they look for other trades, for example, landscaping, pools, that you get complete recurring revenue all
Oh
the time.
yeah.
Mhm.
Oh yeah. I got a scenario for you here then. So I'm just gonna kind of make one up. So let's say that we have two roofing companies out here in Denver, Colorado. One of them is doing $3-4 million, newer company, operations, tech, software, training, all dialed in, brand, SEO, great. And then there's another one who's doing 20 million, but has been doing this for 20 years and hasn't changed anything. How is a potential buyer viewing those two organizations?
Okay, there's a lot that you just said. Okay, there's a lot of variables that you have to look into. The first one, let's go with the first one, which is a $3 million company. The $3 million
Yeah.
company has a lot of appeal to a private equity that would be more into the venture capital kind of thing. Why? Because they don't have a proven record. You said it's a young company, so it's a couple of years, right? So being a couple of years old, not everybody's going to want to buy it, even if it has the latest and greatest technology, because it hasn't really proven that they're moving. Remember, this is very important. And it's not only roofing, it's everywhere. Businesses tend to fail at the 3 to 5 year line. Okay. Unfortunately,
Mm-hmm.
most businesses do fail very early in the process. So if you go through that hump of the 5 years, your business is more likely to succeed. So that's one thing
Got it. Yeah.
so you're going to have a buyer that looks into that. Um, the valuation there, unfortunately, because you just said $3 million, unless you're making $1 million in EBITDA. Okay, that would be the threshold for you to sell to the, I would call the serious buyers. Okay, the people who have the money. They don't typically buy businesses that are less than $1 million in EBITDA. Unfortunately, the first one needs to mature a little bit more, needs to
Mm-hmm.
get the best for them. Okay, and believe it or
Okay.
not, I'm working with several of them that are young guys in their 20s that they started the company, and I have one that has a $9 million company. And it's okay, yes, $9 million, but it's only 3 years old. Let's wait, let's work on it. You're doing all the right things. You're going to get a lot more money in a couple of years down the road. The other one is a 20-year-old company. The value of the business is really high because it's been there for a long time, but it's going to lower the valuation. If it's $20 million company, it has to be making more than $1 million for sure. Okay. At least $2 million in EBITDA. So you need at least 10%. So that company, it's an interesting buy they're not going to pay top dollar for it because it doesn't
Mm-hmm.
have all the bells and whistles that we need today. But it's a really good company that gives you enough cash flow that you can reinvest in it and put all the bells and whistles. Okay. And
Mm-hmm.
there's many of them, by the way. There's a lot of companies that are in that range, 20, $30 million. And when you ask them, they're doing everything manually, that they're using photocopies and they're using paper binders and things like that. Of course, they're not going to get as much as they could if they were a blend between the first one that you told me
Yeah.
and the second one.
So you want a happy medium right there. Now,
Yeah, but you know what? There's buyers, like everything else, there's different buyers for different companies. There's buyers that I work with that are looking for those companies because for them it's a great thing. They come in with all the latest technology and everything, and all of a sudden that $20 million company turns into a $40 million company almost
true,
overnight.
true.
So
Because it's interesting, because the first one, it seemed appealing to me just because I'm like, all right, those people are probably finding all the research, information, consultant, right? To be able to grow that efficiently and so sophisticated, right? That was
yes,
interesting. But like you're saying, if companies are failing at that 3 to 5 year mark, there is a danger zone that
exactly.
it could fail.
Again, balance between risk and reward, the same thing. If that same company is a couple more years older and the owner was smart enough to be the leader of the company and has 2 or 3 very strong managers that will move with the buyer, right? When they buy it, they move. That's a completely different story. And I'm only talking about a couple of years, right?
Yeah.
So
Yeah.
you want to have that. Anybody is going to ask you for at least the last 3 years tax returns. So today, for example, if I ask you for the 3 years tax returns, you don't have 2024 yet. You're not even there yet.
Yeah.
So
True. True. So what
and,
about?
and the big sorry,
Oh, go
the
ahead.
big
No, go
question
ahead.
for the buyer will be, why is he wanting to sell? So how do you
Yeah.
answer that question? Why do you want to sell if you're doing great, if you just started? Now, another possibility, and it would again change the pricing, would be that the owner wants the buyer to buy them to help him grow the company, and the owner is willing to stay in the company to make it grow. Okay.
That's a good
That's
point.
why that's more a venture capital kind of deal. They're going to put money in the company and they're going to let the owner give resources to the owner to get to a much higher level with the company.
I like that. So what about, we obviously said you're the roofing business broker, but we also said you're a myth buster. Is there any other myths or chatter that's going around at the water cooler that's just not right?
Yes. The one that I'm going to say is, I know people probably are going to hate this, but it's a multiplier. Okay. People keep telling, oh,
Oh,
well,
come on.
yeah.
We love the multiplier. I'm in tech, bro. I love the multiplier.
Tech, well, it's not the same when you're in tech than when
Yeah.
you're in roofing. Unfortunately, I wish it was because I would make a hell of a lot more money, but you can't get 10x, 20x. And unfortunately, many people take their valuation from the neighborhood at the barbecue at your house, right? After you drink a few drinks,
Oh,
oh, I
yeah.
sold my company for 20x and I'm set for life. And then you see that they haven't even changed the car. Don't take don't take advice from your neighbor. Take all the barbecue and all the drinks that you want, but not advice on how to sell a company. That's one
No.
myth. The other myth is that private equity is a mean people and they're here to just destroy the industry. The truth is that there's all kinds of private equities. Some of them are really good, some of them are terrible. And you really need to know who they are and you need to work with them. Okay. That's what I would say. It's a pretty big myth.
I know. I completely agree with that. So I was writing down some notes you just said. So all this good knowledge, so I don't make sure I didn't miss anything. What about, I've worked with contractors. Some are just one location, right? Some others multi-state, right?
Yes.
And let's say that if you were able to successfully replicate your model in multi locations throughout the country, that's got to be pretty interesting for someone
Yes.
who's interested in buying because it shows as rinse and repeat.
Of course. Of course. And again, it's much more secure. It's safer to have multiple location in multiple states because you're spreading your risk, right? Let's suppose you're in, I don't know, Florida, Texas, Alabama, whatever, and something happens in one state and maybe they change the laws or you get more competition. The other ones balance out and you can help each other out. The more spread out you are, the better. If you have the same process, that is so much better, right? Because if you're
Mm-hmm.
able to actually copy, paste, and replicate it, then you can use the same platform to continue growing in other places as well. So that's really good. And it provides for a good way to retain your employees. The reason for that is the bigger the company is, the more upside mobility you have. So you can start lower in the company, you can get to manager, supervisor, I don't know, director, or whatever. You're starting to create a way for employees to want to stay more in the company. Now we're in 2025. Most people work in a place for 1 year and then go to the other one. I'm an old guy. I used
You
to
stay?
love the place
You
where I
stay
was.
put?
Well, I'd love to stay put. Yes, of
Yeah.
course. I'd love
Yeah.
to get a promotion every year. But at the end of the day, many people still want to have a promotion and have a safe place where they know that even if there's a crisis, you're going to be safe. And we've been through so many crises. Oh, that's the other myth. Let me talk about this. One of the things that you need to really take advantage of is human nature. Okay. If your business has been growing for the last 3 years and somebody comes and looks at your business and it continues to grow, in his mind, this is a trend, right? So he's going to pay more for that business than if you're at the same number today, but you've been coming down the last 3 years. Now, we know rationally that the past doesn't predict the future, but your mind will use that trend to give you a more subjective valuation. So if you've been growing for the last 3 years, then your business is going to be more valuable than another business that's exactly like you, but it hasn't grown in the last 3 years, right? So you should take advantage of that.
So you're
The
saying
other
if there's like
myth-
a hailstorm or anything like that, hailstorm or whatever it might be, and all of a sudden you just blow up, maximize that opportunity.
Make sure that you maximize this. Now, be careful with that because hailstorms are trackable and people know that it was a hailstorm last year.
Yeah,
Right. So what you need to do, you need to grow your company. Oh, that's another one. Don't grow too fast because when you grow too fast, it might not be sustainable. You want to have a stable growth. Okay. You don't want to
Interesting.
have growth like 50, 60% a year because the question that the buyer is going to say is, okay, that trend really doesn't seem sustainable. Now, if you're growing 10, 20% a year, 30% a year, that's a sustainable. So you want to play with that. And that actually plays against you if you don't know it. And I can give you so many horror stories of people that I remember before I was selling roofing companies, I was selling other types of companies. I sold everything, by the way. I just focused on roofing about a year and a half ago. And I was selling a different company. It was a kitchen remodeling company. And we put the business on the market and everything was going well. And the business was taking off. And while we are getting people interested in the business, the owner calls me and says, Claudio, no, let's take the business off the market. I'm growing too much. I'm like, this is exactly why you want to sell it today. People are crazy for your business. I got all these offers. Oh no, I just want to stay with the business. I said, okay, do what you want. Take the business off the market. And of course, it grew to a point and then it started to go down. And a year and a half later, he calls me, Claudio, we want to sell the business. We're not making enough money. I'm like, sorry, dude, you lost your chance. It's like, what do you mean? But we used to do this amount of money. Yeah, we used to. No one's going to pay you for what you used to. They're going to pay you what you are doing. So
It's
he
like a
lost
stock.
an opportunity of selling a business for a lot of money, and he ended up just closing the business eventually. So it plays
Buy
against you.
low,
You know,
sell high. I mean,
easiest
at
thing
the
to
end of the
do.
day, right? But what happens, motions, all that kind of stuff. And as we bring this a wrap, I'll tell you what, I got another question for you here. Then after that, I let you leave the viewers with whatever you want. It could be wisdom, a book, an article. It doesn't matter what it is. I'll let you close it out. But I sold my last company, and I'll tell you one thing: the process was a lot longer than expected. There's so many things you have to check off. You're looking at liabilities, bank accounts, you're doing negotiations, you have contracts, you have all these crazy things. And then you're worried about, hey, was my team going to be good? You're worried about this, you're worried about this. And then there's like emotional things too, right? Because it's you go from the person who is getting hit up all the time, leading the pack, whatever it is, to all of a sudden now you're like, well, what do I do next? So it's a crazy emotional roller coaster too. So do you have almost like a checklist or just things to be aware of
Yes.
throughout this process that you don't miss?
Yeah, I unfortunately we don't have much time and I talk too much. So what I'm going to do is I'm going to try to summarize it. The way I deal with that, first of all, I said I do a lot of work at the beginning. Big part of what I do is actually being a like psychologist to my clients.
Yeah.
And the way I found the best way to deal with that is I have a series of presentations that as we go through the process, I have a presentation to my clients on the next step, what to expect, what's going to happen, and you don't get so nervous about it, okay? Because if you don't know what's going on, you're going to be nervous, of course. It's a very difficult process. That's why you really shouldn't sell on your own. It's a very difficult
No.
process. It's very emotional, like you said. But if you know at least what to expect, that's going to lower your anxiety, right? For example, when we go into the LOI stage, when we're going to receive LOIs, I sit down with my clients before we receive the LOIs and I say, okay, this is what's going to happen. We're going to receive this. We're going to review them. This is what you have to look for. This is what you have to ask, right? Once we go through that, we go into the due diligence. So I tell them, this is what you need to expect. You're going to get hundreds and hundreds of questions. Many times those questions are going to be duplicated. And I'm going to do the best I can to minimize that. But you have to be ready for that. So if you're ready for that, you're still going to be tired and you're going to be fed up of the process, but at least you were warned in advance. So it gives you an opportunity to get ready for it, to mentally be ready. I don't know if you ever ran a marathon. I ran 3 marathons. I ran Chicago, I ran New York, and I ran Philadelphia. And to me, a marathon is much more about the mental stage on finishing than actually the physical stage. This is very similar to that. It's the mental stage on how you're going to get to the finish line and how somebody like me, for example, can help you get to that finish line without losing your mind.
As somebody who sold a business without the assistance of somebody like Claudio, you guys have to reach out, right? And what's the best way to be able to reach you, Claudio? But I want to say it one more time, guys. Make sure if you guys are looking to sell, planning to sell, want to learn how to sell, hitting him up. I'm telling you, I will never sell a business alone again. So make sure you're reaching out.
So to reach me, you got thebizbroker.com, the roofingbizbroker.com, I'm sorry. It used to be the BizBroker. Now it's a roofingbizbroker.com. You can call me. I can give you my phone number, 954-774-4141. You can email me at claudio.vilas with one L, S at the end, at sunbeltnetwork.com or at theroofingbizbroker.com. Either one is going to get to me. You can follow me on social media. I'm crazy when I post things in social media, but I put some content out there. And I'm going to be doing webinars and things like that. I'll let you know about it, but anytime. And if you don't have to be thinking of selling a business, just give me a call, even if you're thinking of selling it 2 or 3 years from now. Because remember, if you're going to do accrual accounting and you don't start today, you're going to have a lot of high hill to climb then.
You're going to have to go back. I love it. Hey, guys, before I let Claudio close us out with his golden nugget wisdom he's going to leave us with, make sure you like, subscribe, share. Remember, at Better Boss, we're built to be better. So we're always looking to connect with contractors, looking to level up their game and be better than the competition. My man, close us out.
Okay, all I can say is that I do this because I'm passionate, really passionate about the entrepreneurship. I believe the business owner is probably the loneliest person in the world. When things go well, everybody envies you. When things go bad, everybody, bullies you, if you will. You're putting your heart, you're putting your time, you're putting your own money into building a business. And I think it's terrible that at the end of that business life, you would make a bad decision and sell it for less than what it's worth. So out of the respect that I have for business owners is that I do what I do. So that's all I can say.
Hey, entrepreneurship is lonely enough. If you're going to close out that chapter, make sure you reap the benefits, and emotionally, it doesn't just take everything out of you. So having somebody by your side, you're going to have to pay for a therapist if you don't get Claudio anyway. So you might as well save your money, just put it there. It's been an absolute pleasure, my friend. Thanks for hanging out today.